Hey everybody, this is Paul making a quick video. Just my thoughts on the market, where everything's at currently, how's my portfolio performing, and just different things that are going on. So, as it stands right now, my portfolio is currently flat on the year, which is better than most of the other rest of the market, as you can see. If I go out 3 months, if I go out 6 months, if I go out 1 year, and if you go out 2 years, I'm still outperforming the market. The only time I get beat on the market is right here. But so I guess I'll give my thoughts on what's going on, where I think the market's going to go. So as we know, Jerome Powell spoke. The Federal Reserve came out with a statement saying what they're going to do with interest rates. If you follow me on Twitter, you would have probably thought, oh, I was extremely excited when the statement came out. And the reason why I was excited when the statement came out is because everything in the statement was predicted. So initially, when the statement came out, the market basically went up in a straight line. So what did the statement say? So the statement said that there wouldn't be any rate hikes or talk of rate hikes until March, which automatically gives you a whole nother month of no rate hikes. So the market would, in theory, rally in February. They also stated that they would watch inflation, obviously. They also stated that the balance sheet would be something that's not even really talked about at the moment, but would be later on in the year. All of that means that pretty much all of these doom scenarios, like they were gonna, like this meeting, they were gonna hike rates. There were people that were actually saying that and actually believed that, and they were gonna stop the quantitative easing right away and today, and they were gonna do all this crazy stuff that never happened, and everything was predicted. The problem is as soon as Jerome Powell started talking, it was very, very clear from the way that he was talking is that the the statement kind of made you seem like there might be like 3 or 4 rate hikes. When Powell started talking, he started talking and it sounded like 5 rate hikes. And not only would it be 25 basis points, you know, 25 added onto this number right here. So here's the 2 year. So 25 added onto that. But it made it sound like, okay, when we do rate hikes, we think the economy is strong enough to do 50 basis points. Okay, so immediately the market went straight down in a line. And why did the market go straight down in a line? It's because, as I've explained before in previous videos, this is the screen that nobody ever clicks on. It's been so long since I clicked on it that I have to actually agree to it. But this is the bond desk. If you trade bonds, corporate bonds, municipal bonds, I'm sure they use something much more sophisticated, but this is what private people use, like me, if I wanted to buy a bond. But as you can see, as the U.S. Treasury goes up, the cost to borrow, even for AAA companies, goes up. And there used to be a little graph here that kind of showed it, but basically that's kind of what's going on. So as the cost of borrowing for the U.S. government goes up, as the Fed is talking about raising rates, the cost for corporations to borrow goes up. So this might show it right here, average yield maybe, but right now it's still low. So that's why I think the market is kind of really overreacting to this current situation that we're in. But you have to, deal with the hand that you're dealt. So if you go over here, this might actually show it eventually when it loads. But so that's what's kind of, so it's the bond market is feeding through to the cost of borrowing to, and then it's feeding into the stock price. And what that means is basically growth companies that are really not showing any profits right now, that rely on borrowing, and they have very crummy credit scores, credit ratings. So their borrowing costs are much higher than something like, say, Johnson and Johnson. The problem is that those companies, their cost to borrow when they have no revenue is very high. It starts to go higher much quicker. So that's why the bond market moving around now is affecting the actual market. Now, what the market is doing is it is pricing in little bits. It's pricing in rate hikes that haven't even occurred yet. It's actually pricing in tightening that hasn't even occurred yet. It's pricing in the end of QE that hasn't even occurred yet, because the Fed is still technically at zero and 0 to 0.25, and they have not eased yet. They're still buying bonds and stuff until March 15th or March 1st, whenever they decide to stop buying bonds. But the problem is you have things like this. So the market is something called forward looking. And as it stands right now, the market has priced in every rate hike that you would expect between now and the end of the year. And that's just how the market works. They start pricing things in very, very quickly. The markets move very, very quickly whenever the Fed starts talking about rate hikes, especially when you get presidents like this, like guys like this, coming out saying, well, okay, normally you would do 25 basis points every other meeting, which, now we're going to think about doing maybe 50 basis points because we have to slow this down very quickly. So the market is basically, we're going from a situation where the market was very, very easy for a very, very long time to, the world is ending and we have to like raise rates now kind of thing. And as you can tell, that's probably not the best idea to rush it like that with the way that the markets are reacting. And you can kind of see, just how the Nasdaq's been acting, just based on, it's kind of crazy how fast the market has moved. But it's not really that crazy when you think that it's just been relying. So it's been relying on very easy money to make, to get these profit, to get these different values that you see. These different companies that came out, and they just needed easy money. Well, that's over, or that's coming to an end very soon. So where do we go from here? Um, this is where you flip a coin, uh, because there's two narratives in the market right now. The Fed is going to raise until something breaks, and when something breaks, the market is going to fall by 30 to 40% from where we're at now. And then the Federal Reserve is going to have to very quickly reverse themselves. There's also another camp or another theory that says it's all priced in currently. This is probably about as bad as it's going to get. And then for the rest of the year, maybe we rally back to where we were. So the entire year is spent getting back to literally where we were when we began the year. It's kind of crazy if you think about it. So maybe another 10% rise for the entire rest of the year. So that would be like this point right here. I guess this would be like this point right here. So, going in, it was about 15%. So maybe we get a 15% this year. Because technically the Fed has technically done nothing. But because of the way the markets price everything in, it feels like the Fed has done something when they really haven't. All they've done is talk about different things. So if they start pricing in 6, 7, 8, 9, these crazy amount of hikes, you're going to see the bond market go straight up, and you're going to see the Nasdaq go straight down. So what have I been doing in the meantime? So here's what I've been doing in the meantime. So what I've been doing in the meantime is pretty much any extra money that I get, I've been piling it into BST, and I've been piling it into QYLD. I've also bought some AT&T, but Any extra money that I've been able to make or pull out or anything like that has been piled into these two stocks. I am under the narrative right now, and this could be very, very wrong, and I can show you why this could be very, very wrong, that the market may be pricing in too much negativity based on the earnings from Apple and from Microsoft and from Facebook and the different companies that are coming out, because I believe we have Google coming up also. And all of these companies that make up very large parts of the NASDAQ and very large parts of those funds right there just completely blew away their earnings. So when it comes to something like Apple, 0.25 increase in, or point, or even a 1% rise in the interest rates, they don't care because they have just $200 billion sitting there, so they don't even have to borrow money. Microsoft is kind of the same thing. They're just monster companies, and Google is the same way, and they make up just a large part. These other companies like Palantir, the ones that you hear about, like Space, Robinhood, those types of stocks are down 90%, just these insane amounts from where they were. That's because you have to be profitable. So it's called the stock pickers market. It works like a bear market, I guess, if you want to call it that. If Apple, Microsoft, Facebook, basically your FANG stocks all perform like these other stocks, the Nasdaq would be down probably 40% right now, just based on rates. But the Nasdaq is not just these other companies that are just not showing profits. So what I did is basically I'm under the impression that I don't think we're going back to the lows of 2020, and I can show you what those were. If you take this out to the 3-year chart now, that's how long ago this was at this point. So this is how this fund performed in a rising rate environment right here in 2018. This is when rates were really taking off in the Fed, and then right around December, right here, is when when you got into this area, you can see it went from 34 down to 27. And then the Fed reversed course, as they say, and then it kind of traded flat as people piled into the actual stocks, not the ETFs that track the stocks. And then right around here, when it went down to 22, it just took off again, as you can see, as everybody piled back into these types of stocks. So as it stands right now, so this was the peak right here, about $60. So there's two options that are going on with the BST. It could either go to 22, which would put me negative 4,000, give or take a little, or it can go to 60. I have a feeling it's going to go to something in between those two numbers, so something closer to probably about there, and then it's going to settle out. Either way, the money that I'm getting from my, because I cashed in my Works 401k, I was either roll it over or cash it out. I chose to cash it out. Also going to use it to pay down some more credit card debt and that type of stuff, just pay down more debt. But I'm going to take a majority of this amount right here, and I'm going to put a good bit of it into BST. And because my narrative, and this is the Paul narrative as it stands, is that I believe the market may have priced in about as much bad news as we're going to get at the moment whenever it comes to tech stocks. So once that money settles and I get all that money in here, I'm going to end up buying more of BST. This should raise this dividend number up to closer to $3,000 a year, which is close to $280 a month, give or take. This should be up that number by a tremendous amount. So I'm piling most of it into there. That will probably be the most that I end up piling into BST. Any extra money I'll put into the normal stuff, like O or any of my other stocks, utilities. So you have to be very selective on what you're picking in this market. The days of throwing it into any random company and then just walking away with like a 10% gain, like the GMEs of the world, AMCs of the world, I'm pretty sure that's coming to an end. you have the Federal Reserve clearly talking about wanting to raise rates, and they want to raise rates in a very, very big way. So we have to kind of see what's going on. Just given the Jerome Powell press conference and given just the different Fed speakers, some Fed speakers are kind of in line with a lot of what everybody's thinking is if they raise too quick, it's already too late. If you raise too quick, the only way to end this inflation is to literally tank the economy. So some Fed speakers are thinking, but between now and March, there's going to be a jobs report, obviously. There should be a jobs report right here on the 4th. And there will be a jobs report right here. Where are we at? On March 4th, too. So we have two on the 4th. One on the 4th here, one on the 4th there. Those will either show that hiring is slowing, which would make the Fed definitely think twice about raising rates. So if hiring slows dramatically between now and this is the big Fed meeting right here, where they're going to have to we're talking about actually raising rates. So right here is probably going to be the 16th, but that's the one where it's going to be, we're raising rates, and they could say 50 basis points. But that's where you get the dot plot, the thing that shows like where they think the rates are going to go for the next few years. But you're going to get a lot of market volatility. So the way that you play these is if you get massive sell-offs, you buy the dip, and then you get the run-ups as money is just churning in and out of the market. Or we're not doing the steady thing anymore, where I might be able to take this back to 2018. No, I can't take it to 2018. But we're not doing the steady thing anymore, where it's just like steadily, just a nice little, well, not really a nice little line. You probably have to go back here, but if this steady, nice little line where just you expect it to just always go up, you could see major dips. You could see very major dips in how the market performs. You could see these right here. You can realistically see something like this. This type of dip right here. I don't think it would remotely. I think it would probably go to right about there, which is actually right about where we're at. But you could see dips, big time dips. So only put money in the market that you're careful that you don't need, because the Fed could easily drop this off a cliff by being way, way too aggressive. There is a very high chance that I could open my portfolio one thing and this number could say 30,000. They could tank. At that point, that's where you get, if that happens, it's going to take the job market with it. We're going to be in a recession. It's just how the world works. And then nobody's going to be talking about inflation at that point, I can promise you. But yeah, we kind of have to see how it goes. I think the Fed is really late to the party. If they wanted to raise rate, if the Fed really wanted to raise rates, they should have done it here, in here, something in here, not before the market just took off for another year. I think they missed the boat on being able to raise rates. They could have done it in here when Biden even took office. They could have done it anytime in 2021. They chose to do nothing and let the market run, to these insane numbers, which you can see right here. The NASDAQ was up 72%. You can see how disconnected it was from the other markets. It was pretty obvious that, and you can see it right here, it was pretty obvious that it was going to reconnect at some point with the median line where the markets are trading at. It's not even close to, if you're on a historical chart, it's not even close to being close to the median line. It would need to drop a significant amount more to be in line with where the rest of the market actually is, or where all the markets should actually be. If there was zero Fed support ever, if we had actual rates. So, like I said, it's definitely a risky scenario right now. The temptation is to just move to cash and then just wait, but you could be in cash for over a year and a half. I'm still of the impression that I believe our middle of 2023 is our best chance for a recession. Maybe late 2023, because at some point this bond market's going to start pricing in, and I believe it could happen in March, but the bond market is going to start pricing in the rate hikes that they expect in 2023. And that's where you get into a much higher range on the rates, and that could really drop down the market. Or the Fed could come out and be dovish, but just be ready. If you're a dividend guy like I am, then I'm okay with the market going down, because what that means is when my dividends pay out, they're going to pay out and they're going to be able to buy more shares. So when these dividends pay out right here, I'll be able to buy more shares of QYLD, T, Verizon, AbbVie, that type of thing. But it's going to definitely the market is definitely going to swing around a lot more, especially as the Fed tries to pull out of the market after being in for almost 12 years at this point. So definitely have to watch it. So just be ready for big dips. So, if I'm exposed to tech, this little purple line could easily go down to where this little blue line's at very quick if we get another market dump. So I can easily knock 10% off of this very, very, very quickly. So just be careful what you invest in. And if you need the money right away, I would not put it in. If you have a time horizon of 10, 20 years like I do, then, if you see a dip, buy a dip. Because, it's going to eventually go back to where it was, but, you know, it's going to be definitely swinging around a lot on you. So hopefully that clears up a lot of it. If you have any questions, of course, leave them in the comment section. But thank you so much, and y'all have a nice day.